Hey guys, Tashi here again with another video on finances. And today we're going to be talking about mortgage insurance versus personal insurance. I want to say thank you so much for supporting my channel. Thank you for liking my page. Thank you for subscribing. So every time I put out a video, you'll be the first to know. Thank you for leaving a comment down below, and thank you very much for sharing, because you never know who might need this bit of information. So if you're interested in the topic that I said before, please stay tuned, and we are going to jump right into it right now, because things we all need to know. Never mind my here, sorry, it's the end of a day of working as a financial advisor, and yeah, I'm drained. So let's quickly run through this video. So as I said, we're going to be talking about mortgage insurance versus personal insurance. So first things first, for mortgage insurance, it's going to be paying out on the decreasing payout end. So that's a big no-no. You don't want that. What that means is, if you have a mortgage that's valued at say $300,000, and you go to the insurance company or the bank, most of the time they're the ones who offer that mortgage insurance. They're going to say to you, okay, you need to insure the mortgage in case you die. That way we're sure that we will get our money, we will be paid. So they will sign you up for mortgage insurance for $300,000, because that's the mortgage you took out at the time. Let's say you pay that mortgage for 10 years, and now you have 200,000 owed on the mortgage. Unfortunately, you passed away. Now remember, your face amount that they told you when you took the mortgage insurance was $300,000. Now the owner for the mortgage passed away, but however only 200,000 is left on the mortgage, because the person, while they were living, they were paying their mortgage and they paid off 100,000. Now the insurance company would not pay the 300,000, which you were told was the initial payout in the event you should die. They will only pay the 200,000 that is left at the time that the person died, that is owed on the mortgage, because it's on the decreasing payout. However, the premiums you pay for this does not change, even though you're gonna get a less payout, because of course you're paying down your mortgage, and they only pay what is left on the what is owed on the mortgage at the time of death. But if you were paying $100 from day one of having the policy, you're going to be continuing to pay $100 of premium right up until the end, even though you're going to get a less payout, because you're paying down your mortgage. So that's number one, why you should not take mortgage insurance. On the flip side, if you compare that to personal insurance, like your life insurance, would have a fixed payout. So if you were told that your face amount is 300,000, and even if you paid that mortgage for say 10 years, and then after that the owner of the mortgage died, and but however only 200,000 was left owed, the life insurance company will pay you out the full $300,000. And what that means is, now you could have 100,000, well, your family, your beneficiary who is left alive, would have 100,000 left that they could use to invest, or they could invest it conservatively and make some income from it, as the person, the spouse who dies, that income is gone. So the money that is left, pay off the mortgage for 200,000, they have 100,000 left, they can invest that conservatively, and they can have some monthly income coming in to fill the gap of the person who passed away, unfortunately. So that's check mark for personal life insurance. That's the first comparison. The second comparison between the two, we're going to talk about, for mortgage insurance, you pay group premiums. And what group premiums mean is that when you are evaluated on how much you're going to pay per month for your premium, monthly premium, you are grouped with a bunch of people. So I'm in my mid-30s. They might group me with people in their mid-30s. I don't smoke. I don't have, thanks be to God, I'm in good health, I'm healthy. However, I might be grouped with someone who's in their mid-30s that had suffered a heart attack. Unfortunately, we don't wish that on anyone. But what I'm saying is that you're grouped with everybody, and therefore it's like you're paying for other people in the event you're a perfectly healthy person. It's not like you don't want to be paying for other person's bill. So that's number two. It's group premium, which is a no-no. because you're an individual. On the flip side, for personal life insurance, there are individual premiums, and these are typically less. Why? Because they look at you as an individual, they look at your lifestyle, and then they say, okay, based on the fact that you're healthy, you've never had any critical illnesses, you don't smoke, you've never used drugs, you don't do any dangerous sports, this is what you're gonna pay. It's most times, it's typically less than mortgage insurance that you would be paying group premiums. Personal life insurance is usually much less, and I can attest to that. I can tell you, and I'm going to tell you at the end of the video my scenario. Okay, the third thing that we're going to compare is that with mortgage insurance, it's post-claim underwriting, and that's a definite no-no. That's a no-no. Why that's a no-no? Post-claim underwriting simply means when you go to get that insurance to cover the mortgage, they're gonna say, okay, you need 300,000, okay, bap, 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 and you go and you sign away and you sign the paper, and then you go home and you're paying these premiums, and you're like, oh, we have the mortgage covered. If my husband should pass away, or if my wife should pass away, then we know that the mortgage would be paid off. Let's say a spouse passed away, unfortunately. Now, the cause of death, let's say it's like a drug overdose or some sort of critical illness or something like that. But when you go to claim that funds to pay off the mortgage, you're told by the insurance the banks, we don't cover the cost of debt. Now, what are you going to do? You've been paying this premium for over 10 years, and at the end of the day, now, you know, your spouse passed away, you're already in enough ache, grieving, you know, everything, your whole world is turned upside down, and now you hear we are not going to cover that because the cause of death, it's in the fine print, we don't cover that illness, or we don't cover that situation. So that's a no-no. And you won't know until after the person dies, because it's post-claim underwriting. They do it after, which is, it doesn't make any sense. Trust me, you don't want to be in that situation. On the flip side, for personal life insurance, it's upfront underwriting. So when you go to take out your policy, your insurance company is going to let you know whether they need a medical there and then. If they do need a medical, most insurance companies these days, they'll send the technicians to your house to get your blood pulled. They'll collect your urine. They'll ask you questions. Most insurance companies are sending people at your home at your convenience. People are coming to people's home on Sundays, that holidays, nights, mornings. It's whenever it works for you, which I think is absolutely awesome. Hands down to that. Like, yeah. So once they say to you, you are insured, if death should come along the way, there are no surprises, because they said, okay, we knew all of this up front and we covered you. Here is your 300,000. Go take care of your family. So that's that. Those are the three things. So just to go over quickly, mortgage insurance, it's on the decreasing payout. Meanwhile, personal insurance is on a fixed payout. For mortgage insurance, group premiums. Personal life insurance, it's individual premiums, which are typically less. And for mortgage insurance, post-claim underwriting. Meanwhile, for personal life insurance, it's upfront underwriting. So I hope this information helps someone today. If you're looking to take out a mortgage, if you already have a mortgage and you didn't know these things, of course, go to your bank, speak to somebody, have them look at your situation and see what you can make best. See if you can save some money, because at the end of the day, we all need to be saving money. Now, I'm going to give you my little scenario with this. So I bought my place a few years ago. I did not know that I didn't have to take mortgage insurance. When I went to the bank, they told me straight off the bat, you need mortgage insurance, you have to take it. Boom, boom, boom. They included it in the mortgage. I didn't know that I could use my life insurance policy to cover my mortgage. The main thing that you need to make sure of is that your life insurance policy is of equal or more value than the mortgage. It cannot be less than the mortgage, or else you cannot use it. So if you have a mortgage for 300,000, As long as your life insurance policy is 300,000 or more, you can use it to cover your mortgage. You do not need mortgage insurance. Please. I was paying mortgage insurance for a period of time, $168 per month, and I didn't know that my life insurance, which cost $50 per month, could have covered my mortgage. As soon as I find out, I got things changed, and I started saving $168 pretty much. So you can use your life insurance to do multiple things. It can be used to do multiple things. So please go speak to someone at your bank. I hope this information helped you out today. Please remember, like my page, subscribe to my page, so every time I upload a video, you'll be the first to be notified. Please leave a comment. Let me know your experience. Let me know if this piece of information helped you out. And of course, have a wonderful day. As I always say, stay blessed. God loves you,